Hi guys, thanks for tuning in to another episode of Nuggets News. Well, I've got a really special whiteboard video for you today. We're going to be talking all about how the US energy sector and the junk bond market could start the collapse of the house of cards of the entire corporate bond market and really the US economy and another leg down in the stock market. So this is going to tie together a lot of concepts that we talk about regularly on the channel, but particularly the video I did about interest rates. So I'm going to link that down below because it will build on that knowledge in particular. So there's a lot on the whiteboard. I'm going to clearly explain it all to you, and by the end of this video you're going to understand how the US energy sector works, why we got a bit of a bubble in junk bonds, particularly for shale oil, and why the likes of Saudi Arabia and Russia and a lot of these competitors, the OPEC oil producing nations, are frustrated that America's basically had an advantage that no other country has. And I'm going to talk about why that is. So let's start off up the top here. This is a list of countries and their oil reserves in billions of barrels. So Venezuela actually tops the list. And a lot of you will know that Venezuela is a country that's experiencing a lot of hardship and hyperinflation. So just because you've got a resource-rich economy doesn't necessarily mean that's going to bring about wealth. And I'm going to talk about what you need to do to actually turn that into production, and the US actually tops that list now. So over there on the far right hand side, we've got the top list of billions of barrels per year, and the US has recently crept to number one past these oil giants. You hear about Saudi Arabia, Russia, and then in the middle there, Iraq, Iran. China's up the list there a little bit as well. And I've put in a special mention there, Venezuela at number 11, because they've just got so much capacity, but for all the reasons we're going to get into, they're just not succeeding. And it's maybe a glimpse into what could happen in the US if they lose that world reserve currency status and the advantage that they have, which we're going to get into. Final one I mentioned here is China. They're number 13 in terms of reserves, but they are a superpower, and we're seeing the trade war and that economic battle happen on a slightly different front. But this is also very important because whoever's got all the commodities, and particularly energy, they've got a lot of wealth behind them as well. So let's talk about the fight for number one, because US wasn't number one until very, very recently. So here we've got Saudi Arabia, the green line, Russia in red, the USA in blue. And we go back to 2005, and you can see the first two, they kind of track and trace each other. They're friends. A lot of the OPEC nations, they generally try to get along because they want to get the best price for their oil. They all want to be reasonably profitable. But then something changed after the GFC in 2010 when the US hugely ramped up their production of oil. Now, we had a bit of a battle here where the US oil production fell off a cliff, and then it bounced back really sharply, and they finally managed to surpass the other two for good, and they've held on to that number one position for a year now. So we're going to talk about how that happened with the shale oil boom. Now, if you don't know what shale oil is, let's talk about the price of oil and how oil is produced. So over here, we've got a chart with the price of oil in black, the stock market in blue, and I've got interest rates in the US in green here as well. And that's really important. As I said before, we're going to build on that video I did a little while back, and I'll link that down below. So here you can see the cost of production for different countries, or, this is a generalization. Obviously, there's a lot of overlap here and there's subtle differences and whatnot. But as a general rule of thumb, some of these countries in the Middle East have got a very low cost of production with oil. Now, other things come into that as well. So the cost to actually produce a barrel of oil is different to the total cost and that capital expenditure, the money you have to put in to maybe transport it and whatnot. But generally speaking, the Middle East has got a very, very low cost of production. We're talking $10, $20 a barrel barrel and they're still making money. So then you work your way up the list, and the general things that make oil more expensive to get at and produce and get out of the ground is, well, is it onshore or is it out there, in the water somewhere, and you've got to set up those offshore rigs? Is it in deep water, as you might have heard of when we had the oil spill? And then we move into things like the shale oil in the US, where we actually have to drill down, frack the ground. There's all these newer techniques now where we can do horizontal fracking rather than just drilling down vertically. So it gets very complicated. There's a whole nother discussion around whether or not that is, safe to do, environmentally friendly to do. We know the world is turning more to that sort of renewable, greener theme in some ways. So look, that's a whole nother kettle of fish. Let's not get into that today. And then the most expensive, you might have heard of things like the Canadian tar sands, where there's a lot of processing to get oil extracted out of these sands. So all those different things that make it more expensive and harder to do. In Russia, you might be trying to get oil out of these ice sheets and you've got to pay employees more, then transport it. So all those little things add up to how much it costs to produce a barrel of oil. So the US, the shale type production falls somewhere in between, let's call it $30 and $70 a barrel. So when oil is down here under $50 a barrel back in the early 2000s, it doesn't make it profitable. You can't, produce shale oil. Now then we have this big run up into the GFC when the economy's booming, everyone's using lots of oil. We had fears about peak oil and whatnot, and sure enough, the price fell off a cliff. And then with that, along with the stock market falling off a cliff, demand drops. So all those things add up to less oil being used, supply and demand. We get a really low price, and I think it got down to around $25 a barrel. Now, this is where the story gets really important with the US Federal Reserve and a lot of countries around the world dropping interest rates to near zero, and they started doing that money printing, okay? Now, the US have got this really unique position where they're the world reserve currency. They've actually got the petrodollar. So a lot of the oil around the world has always been traded in dollars. Now, that's slightly changing now with different countries, some of those on the list, now doing deals with each other to settle in their own currency or to possibly settle in gold. Venezuela are trying their petro cryptocurrency. Maybe we'll see Bitcoin or other stable coins and other central bank digital currencies in future. But the point is that the US have had this very unique position where their whole economy can go into more debt and it doesn't really hyperinflate their currency. Like Venezuela, for example, when they're printing lots of money and just spending on things, it comes time to pay the piper a lot sooner than if you're the world reserve currency and everyone else around the world is still demanding dollars. And again, I've done a lot of videos on the US dollar recently and why everyone wants those at the moment. Now, long term, I think that's all going to change with how much debt the US have got and how people are trying to move away from the US dollar. But this is what allowed them to do massive investment in different industries. And because interest rates were so low, investors were starved for yield. So instead of being able to get 5% in your savings account, 4% on a government bond, all of a sudden you were getting no return on your money. So people were saying, well, where can I buy bonds? And they worked their way up that risk curve that we often speak about. So these energy companies are offering these bonds that pay maybe a 6 or 7% dividend, and investors are saying, that's great, let's invest there. Now, oil recovered and it stayed relatively high, around $90 a barrel for sort of 3 years, and that allowed a lot of investment because all these companies, these shale companies that couldn't produce oil, there's no point going out there and doing all the exploration and drilling and setting up these rigs and wells if it's going to cost you $60 a barrel and oil's only $30 a barrel. All of a sudden it became economically viable to produce shale oil, and you can see that production ramped up massively, and nearly all of that increase in production capacity has come from the shale oil in the US. So it's now responsible for more than 50% of US oil production. Now, the cost does come down slightly, like anything, when you get better technology and newer fracking methods that I spoke about. better means of extraction. So you might be able to go back to an old well and get out a bit more oil. But basically, that cost of production is still higher than the Middle East and Russia, a lot of the OPEC nations. So back in 2015, we had another scare, a bit of a slowdown, a bit of a battle between these guys, the powerhouses that all want to be number one, where they were all ramping up production, and the US did sort of lose that battle there, because when oil prices fall, they've got no choice but to turn off some of those shale oil wells, because there's no point trying to compete with oil prices so low. Now, to some degree, they still have to keep the pumps flowing, because you're better off making some money than none at all. And a lot of them had issued a lot of debt. So this is where we have the Fed dropping rates, printing all this money. We're in the middle of QE 1, 2, and 3, where they're pumping money into these investment banks. They can borrow and buy back shares, and the oil companies themselves are borrowing all this money and issuing these bonds, and they got into a bit of trouble here, but they were allowed to roll that debt over. Interest rates were still low, and they're saying, let's give it time. We still think you guys can pay that back. Let's refinance at these low interest rates. Oil's going to recover. You're going to be fine. And they've refinanced that debt out 5 years further in the future, and a lot of that is coming due now. So then the rest of the story. From that point on, the economy really recovered, and we had strong growth, a lot of demand for oil. Stock markets are ripping higher. There's money everywhere, so everyone's feeling really good. And literally, the stock market went off my chart here. You can see over 3,000, and you guys know the story. It peaked recently, and I did the video about how we're literally in a mad world, and fundamentals have detached from reality, and we're probably going to have a correction. And sure enough, we fell off that cliff. We've had a bit of a bounce now. But the fact that stocks had around a 30% correction, 40%, the energy sector got hit a lot harder. I'm going to talk about why this all is. So these are the ETFs and some of the stocks you can trade. For those of you doing your trading on eToro, for example, these are all available where you can buy them or short them or whatnot. And this was a good trade that I had recently. So we've got USO is the oil ETF. UNG is the natural gas ETF. Natural gas is a byproduct with a lot of these companies as well. You'll get natural gas. XOP is the oil and gas explorer and producer ETF. So that is the one that you want to trade when you're looking at ideas like this. And that's the one that I shorted recently. Occidental Petroleum, that's probably one of the better companies you'd consider in the US energy sector. And Whiting Petroleum, maybe one of the weaker ones. Now, their share price peaked at around $400 a number of years ago, and it's down to under 40 cents. So that's down 99.99% in the last few years. But recently with this fall, it's fallen 90%. So a lot of these stocks have really been hit hard compared to the overall market. And this is where we get into people saying, well, that's just the energy sector, and that's just because oil's fallen 70% in price. But I think this is where the greater risk lies, that this can be the house of cards that brings down the wider corporate bond market. And this is going to be part one of a two-part video. So the final piece on this chart that I want to talk about here is the number of companies in the US shale oil sector and their break-even cost. So with all this debt that is coming due starting this year and the next 2 years in particular, we're talking hundreds of billions of dollars that they borrowed and issued these bonds that now need to be paid, plus that interest rate. So I think in 2014 alone, it was something like $250 billion, $250 billion. This is huge numbers that we're talking about, guys. This isn't just a little, few companies here or there. We're talking hundreds of companies and hundreds of billions of dollars, and it's coming time to pay the piper. Now, unlike 2015, 16, when we had a bit of a stumble in the oil price and a strong recovery, this time is different. I know those words are dangerous, but we've got the COVID crisis at the moment with world economies in lockdown, and we've seen that huge supply shock. So we're going to be using a lot less oil for at least the next few months, even if things do start to recover. So we're not going to see this aggressive growth like we saw in the past. So the US is not going to be able to stay number one at these low prices. That production from shale is going to have to fall to some degree. And this is why Saudi Arabia and Russia are playing this like a game of chess. They're both kind of maybe blaming the other one and not coming to the party and backing away from some of these talks and negotiations. The other day, Trump comes out and tweets saying that he's talking to them and they're going to cut back 10 million barrels a day production. Look, I'm not sure if any of that's going to happen, but if you were those two, you know that if you keep oil prices low, this is the percent of companies and the break-even price that they need down the bottom here. So if they can keep oil just in between $20 and $30, for example, they know that 95% of these companies are only just going to be breaking even. They're not going to be making money. So A, they can't profit, and B, they can't pay down that debt. And if they can keep oil under $20 a barrel, the other day it nudged $19, 100% of US shale companies. Now, there might be a few, outliers, as I said before, and a few exceptions that have better balance sheets and they're going to only use the wells that do have a lower cost to some of their other wells and rigs and whatnot. But the point is that they can really wipe out the majority of the US shale sector if they can keep those prices low. And that means that they are going to default on all that debt. I don't think they're going to be able to roll it over again like they did in the past because investors don't have that same appetite where it was a little bit euphoric. There was easy money. A lot of these investors are sitting on huge losses. They don't have that capital. They're just going to dish out to these really risky companies. And that's why you've seen the yield on these bonds blow out. So again, referencing the video I did recently, we spoke about how going up that risk curve to get a slightly better reward, it actually came with way more risk than what was being priced in. So a US government bond was paying a couple of percent and a high yield junk bond was only paying a couple of percent more. Now that has blown out again. So those rates are in some instances 15% higher than what they were even just a few months ago, a year ago. So that is tying it all together. It's bad news for these companies if oil prices don't go up. The US have had a really unique position. They've possibly abused that. Some people can argue. Either way, the superpowers, you've got the trade war with China and the US, and now you've got Saudi Arabia, Russia, and the OPEC nations that don't want to see US as the number one producer. If they can get rid of them altogether, shut those companies down, it's going to be hard for them to bounce back and start back up. That means that they're all going to make more money and for all the reserves that they've still got up their sleeve. And I think that this is a really interesting time to watch these markets play out. So guys, if you have enjoyed this video and you like my style of thinking here, tying everything together, I do daily updates in my Facebook group. If you want to trade these, we've still got that $100 sign-up bonus for eToro. If you want to practice and you haven't done that before, they've got that virtual trading account. And hopefully you've enjoyed this video. Give it a thumbs up, share it around with your friends, subscribe if you haven't already, and I'll talk to you again soon. Cheers.